We don't blame you if debt is a word you're instinctively afraid of. After all, when you come across so many television shows, books, and magazines dedicated to helping people get out of debt, you do tend to see it as a negative measure. But guess what? Contrary to what most people may believe, debt can actually help you build your wealth, especially if used responsibly with a clear plan and objective. Another misconception regarding debt is that it's only for the poor. False. There are tons of ultra-wealthy people who take on debt to invest the money elsewhere. In fact, we'll let you in on a little secret. Rich people always seem to be getting richer because they know when and how to use their debt. So, if you're wondering what the secrets are and how you can use debt to make more money, you're in the right place. But before we get started, make sure you've hit the like button and subscribe to our channel for more amazing content. Let's roll. Number 5. Debt recycling. Before we get started with the concept of debt recycling, it's essential that you know how to differentiate between efficient debt and inefficient debt. To put it simply, inefficient debt tends to be the kind associated with assets that depreciate in value. That is, they have no potential of producing income or offering tax benefits. Some common examples can include car loans or using a credit card to pay for a holiday. Alternatively, you can acquire debt with the intention of purchasing assets that could grow in value over time, or even generate income that could be used to pay back the debt taken. This is what we refer to as efficient debt, and it's one of the fundamental methods that rich people use to get even richer. So the point is, you should be focusing on getting rid of inefficient debt because that's most likely reducing your wealth due to associated interest and fees. Debt recycling is a super effective strategy that converts some of your inefficient debt, which doesn't generate capital growth or income, into debt that may be efficient. One way to do this is using a lump sum amount of money, possibly received from a bonus or inheritance, to pay off your inefficient debt. Then, if you borrow the same amount and invest it elsewhere, you would be pretty much replacing the inefficient debt with tax-deductible debt that has the potential to generate immense wealth. For your particular needs, we'd advise consulting a financial advisor and exploring all the other options for implementing a debt recycling strategy, all with varying levels of risk. Number 4, refinancing. In simple words, refinancing a mortgage means paying off an existing loan and replacing it with a new one. It can both save you tons of money or end up costing you a lot, depending on how you go about it. There are multiple reasons why homeowners refinance, and getting a mortgage with a lower interest rate is one of the fundamental ones. If you can reduce your interest rate by at least 2%, then refinancing is undoubtedly a good idea for you. As a result, when you reduce your interest rate, you not only save money, but also increase the rate at which you build equity in your home. Moreover, it can also decrease the size of your monthly payment. You can even refinance to shorten the loan's term. When interest rates fall, homeowners sometimes have the opportunity to refinance an existing loan for another loan that has a shorter term without any significant change in the monthly payment. Other than rate and term refinance, you also have the option of cash-out refinance. In this type, you can refinance up to 80% of the current value of your home for cash. Let's suppose that your house is valued at $100,000 and you owe $60,000 on your loan. Well, then your bank or lender can provide you in $20,000 in cash out, making your new mortgage valued at $80,000. You're not always saving money by refinancing, but instead getting a form of a lower interest loan on some needed cash. If you have an adjustable rate mortgage, another smart move can be refinancing to a fixed rate loan. Additionally, if you've been paying for private mortgage insurance, refinancing can eliminate those payments if you've reached at least 20% equity in your home. Number 3, margin investing. This is the practice of borrowing money from a brokerage firm to make investments. Rich people often use this to increase buying power and then pay the sum borrowed back at a later date. However, it's important to note that this practice comes with its fair share of risks, and if you're an inexperienced investor, it's better to be cautious and explore the market more closely. The concept is fairly simple to understand at first glance. A margin account provides you the resources to buy more quantities of stock than what you can afford on your own. Buying on margin is seriously more enticing than using cash, although With the potential for higher returns, there's also increased risk. But for the wealthy, that's where the fun lies. It's basically a form of leverage that investors use to magnify their returns and invest more than they usually would, or even diversify among a more significant number of investments. Let's say that you want to buy $10,000 worth of some stock. You can pay $5,000 in cash and buy on the margin the other $5,000. If you're lucky and your investment grows by, let's say, 25% to $12,500, your actual return on investment would be 50%, considering that your cash outlay was only $5,000. Sounds like a pretty genius idea, doesn't it? Despite all the potential, it's important to note that brokers don't lend margin funds for free, and they're often charged interest. But at the same time, margin rates are generally lower than the annual percentage rates of personal loans and credit cards. Number 2, Forex. The foreign exchange market, more commonly referred to as FX or Forex, is a global marketplace for exchanging national currencies. Currencies are essential because you can't use your local money to buy goods or services across borders. Therefore, international currencies need to be exchanged to enable people to conduct foreign trade and business. One unique and somewhat surprising aspect of this global market is that there's no central marketplace for foreign exchange. Instead, currency trading is done electronically over the counter. This means that all transactions occur via computer networks, as opposed to there being one centralized exchange. So, unlike any other financial market, investors can almost always respond to currency fluctuations caused by economic, political, and social events as they occur, without the need to wait for markets to reopen. Forex trading has multiple advantages, but they particularly stand out if you're a beginner. It's highly accessible compared to other markets. It's reasonably easy to enter without the need for a massive initial investment. The rolling hours of the market are also pretty attractive. Since foreign exchange takes place over the counter, the operation is not dependent on any centralized exchange system. As long as there's a market open somewhere in the world, you're good to go. The availability of leverage is another highly appealing reason to trade Forex, since it allows you to open a high position with a small amount of capital. And number 1, credit score and credit card arbitrage. One of the most critical factors when it comes to your finances is your credit score. It ultimately determines if you're eligible to get a loan or line of credit. If you have a high credit score, you get to enjoy certain privileges that are inaccessible to other cardholders. These can include fast approvals when you apply for loans and even lower interest rates. And most importantly, you can profit from credit card arbitrage. This is basically the process of borrowing money from your credit card company for an investment that'll generate more than the interest you're paying on the money borrowed. It's not rocket science, but it does require a bit of tactic. The lowest risk and most common type of credit card arbitrage includes taking advantage of a 0% introductory annual percentage rate balance transfer offer to borrow thousands of dollars from a credit card for the duration of the initial period. The borrower can then place this money in a higher interest but lower risk alternative. This could include a savings account, money market account, or certificate of deposit, where the interest rate might vary from 1% to 5%.